Intel at the peak didn't just underperform the market, they've been waiting 25 years to break even, but Intel isn't the cautionary tale. Intel is just the one you can show on a chart. JP Morgan analyzed every Russell 3000 stock from 1980 to 2014, roughly 13,000 companies, and found that 40% suffered a permanent decline of 70% or more from their peak. In tech specifically, nearly 2/3 experienced catastrophic loss. The index returns look good because a small handful of extreme winners compensated for everyone else. You don't get to know which bucket your stock is in before you decide how much to hold. The rule most portfolio managers agree on: no single position above 10% of your portfolio. Most say 5% is safer. The attachment is the trap, not the asset itself. Trap 3. Tax inefficiency, the slow bleed nobody notices. You had a great year. Portfolio up, sold a position that doubled, you're feeling good. Then March comes, you open TurboTax, and you're staring at a number that doesn't make sense. You made $60,000 on that trade. You owe $24,480 in taxes. Not because you did anything wrong, not because of some audit. Because you sold the position in month 11 instead of month 13, you owe nearly $10,000 in unnecessary taxes on a single $50,000 gain just because you were impatient. This is what tax inefficiency looks like, not fraud. Not complexity, just timing mistakes and placement errors nobody sat you down and explained. Morningstar found the average equity mutual fund lost 1.48% of its returns annually to taxes. Compounded over 20 years, that's roughly a 35% reduction in ending wealth. On a $500,000 portfolio, you're looking at $175,000 gone. Not too bad investments, not to a crash. Too poor tax management. The most common mistakes: holding high dividend stocks and REITs in a taxable brokerage instead of an IRA. Every dividend becomes a taxable event whether you wanted to sell anything or not. Not harvesting losses. When a position is down, selling it locks in a loss you can use to offset gains elsewhere without changing your market exposure. And selling before holding a full year, if short-term gains are taxed up to 43.4%. Including the net investment income tax, while long-term gains max out at 23.8%. That 19.6-point spread costs you $9,800 on a $50,000 gain because you couldn't wait 2 more months. Taxes are almost certainly your single largest annual expense, bigger than your mortgage, bigger than any—
Subscribe now to watch part 4.